What's going on, guys? This video is to discuss how to buy a naked put or a bearish position on a stock or an ETF. This is, if you think the stock is going to drop or if you think the whole market's going to go down in general, you can actually profit from that, and you can do that by buying puts. So on the Thinkorswim platform, this is the web version. You'll go to the stock or ETF that you're bearish on. This is not investment advice. This is just an example. So I selected Microsoft here, and it's nice. They do weekly options, so we can just go a couple weeks out. And this side is the calls, and this side is the puts. So it's currently at 242. So we're going to go down a little bit. And this is where we're going to be looking at. So these are all the puts here. This is after hours, so I'm not going to be able to purchase this trade or anything, but this is just showing that what you're going to want to do is pretty much buy in between both of these. So this is the ask and this is the bid. So whenever you purchase this, you're going to want to buy somewhere in the middle. So you can see here's 21 per contract. So your max risk here is $21. And the probability of this happening is very low. You can see here this column says probability in the money. So that's pretty much saying, based upon the current market and the current price, the chances of this contract being in the money is not very high, not very likely. So this is an out of the money put because it's not in the money yet. If it would be in the money, it would be above it would be above 242 where it currently is trading at, but it is actually out of the money at 212. So this is a very risky play, and the chances of this actually, becoming profitable, in my opinion, is pretty small. But the market we're living in today, guys, anything can happen. So do invest and be sure you know what you're doing before investing into options, particularly because they are definitely more risky than individual stocks. But I just want to make this quick video discussing that. So, as far as determining how far out of the money you want to go, that's all going to determine, based upon your fundamental analysis and how much you think it could drop in a week, a month, 2 months, whatever you think. Because do remember, every day that these go by, let's see where our theta is. Let's see, where's it at? So our theta, so you can see our theta column right here. So every day that this, contract, and every day that passes, this amount of money is going to eat away at our contract value here. So, if you buy a put, that theta is working against you, right? So every day that passes, $5 is going to be getting ate away from this underlying contract here. Now, if you're selling it, you essentially would be making money from that because the contract would be decreasing in value. And if you sold it, that's a good thing because you sold it for, say 32, and then a couple of days later it's at 25. You could buy back that contract for, a profit of $7 minus the commissions here. But as you can see, the probability out of the money, like I mentioned, is just the opposite of this. So the chance of this actually happening is very unlikely. But as you can see, as you get closer to the money here, at the money price, it gets higher. So if you buy an in the money put, the chances of that being profitable, not necessarily profitable, the chances of that being in the money at expiration is much higher. So how that works is, you buy a 260 put. So that's pretty much saying that you think it's going to drop by $19 from 260. So that would be our break-even price, right? And I think TD Ameritrade actually shows us that on here. I'll show you guys. Yeah, so they have this cool little chart here. So, it's at 240, and if you sold a 260, that's pretty much assuming that you think it's going to go below 242, obviously before expiration, but maybe in the 230s, which could be very realistic. You see our 260 put is down here. This is if it goes up, but if the stock price goes down in value, that's where we make our money. And you can see this P&L right here. You know, the more it drops, say it drops, you know, $5, which is, you know, very, very possible for any stock, but $5 over the span of 2 weeks, you can see we could be very, very profitable here. So it's currently at, like I said, 242. So if it drops $10 at expiration, we would make around $778 there. So yeah, TD Ameritrade does a really good job at, you know, kind of helping visualize that. Obviously, if you are still kind of lost with this stuff, I definitely recommend jumping onto the paper trading platform. That way you can, you know, buy options and buy all these naked positions and not really blow up your account, because you don't necessarily have a feel for how the contracts work and stuff like that. So that's definitely what I recommend. If you're new to options, go open a paper trading account and go all in, man. Just start buying stuff and really try to fail as much as you can, just so you can get an understanding of, for one, it's paper money, so you don't have to worry about losing it. If you lose it all, great. Hopefully you're learning from it, right? Compared to using your real money and, you know, doing some crazy out of the money plays and then, you know, wondering why you blew up your account in 2 months or whatever. So that's my advice there. I will leave a link below to the Thinkorswim platform. Feel free to check that out. It's pretty good. It's very easy for beginners, in my opinion. And like I said, the paper money is well worth it as well. So, all right, guys, that's pretty much it for this video. Thanks for watching.